Welcome back to another episode of the Beckonomics Podcast. Today we're joined by the man himself, Frank Beck, CIO and founder of Beck Capital Management. Frank, good morning. I think we have a good topic today, kind of giving everybody a rundown on our investment process at Beck Capital Management and kind of how we approach the world.
Well, thank you. I think that it's a somewhat different process than a lot. We call it our 30,000 foot view of the world. We'd like to imagine that you're looking down at the world and seeing how money is flowing. There's big macro themes that go on. There's government things such as the Federal Reserve. Are they raising interest rates here, lowering them someplace else? Are they raising them here and in Europe? All those things affect capital flows. And one thing that we're certain of is that money always flows to where it's treated best. So we're looking at those types of flows and determining what sectors, what countries, and then what sectors within those countries, and even sometimes to subsector is the place to invest. And also, almost as importantly, or probably as importantly, where are the places to avoid? The United States for many years has been kind of the best place to invest most of your capital. But within our own economy, there have been sectors that were highly favored and some that were completely out of favor due to things like rising interest rates and people nearshoring because of China. So we have onshoring, we have nearshoring like in Mexico, we have capitals moving around the world right now.
Yeah, I think a lot of that can be seen in India right now too with the friendshoring. You know, we have those established trade lines through Asia in that area of the world, but getting those moved out of China into a more democratically friendly country like India has been driving a lot of growth for them right now. And so just kind of like taking that, one step at a time, start the global level. Like you mentioned, Mexico, US, India are really in favor right now, seeing a lot of projects and capital flowing into them. And then even taking one more step down the ladder, getting a little closer to Earth, you have your macro forces like we're seeing with AI throughout the world, but largely concentrated in the US as far as that innovation and the main companies that are players in the space, right?
Certainly. It's AI, and then of course we have, dovetailing with it, we have autonomous vehicles. We have AR, artificial reality. But the common theme that a lot of them have is some of the semiconductors that are used in it, the graphics processing units and such. So that makes for a big theme. It's a theme that we like to not only invest in, but stay invested as long as that theme is playing out. We're not someone to rebalance that position. Or to rebalance the portfolio on a calendar basis. Rather, we like to, sometimes you need to trim a position because it grows so fast that pretty soon it will wag the dog or it will wag the portfolio one positions. So we're more likely to trim a position versus just go in and rebalance a portfolio because it became April 1st or July 1st or something.
Yeah, I'm glad you brought that up because that's one of the biggest differences in having that sector and macro approach is that you're not doing this calendar rebalancing like a lot of people do. And, taking AI for an example, NVIDIA has done great over the past few years, and to calendar rebalance that on, call it a quarterly basis, doesn't really make any sense, especially because one, your macro trend has not changed. Companies are still pumping more and more money into AI now more than ever. And two, NVIDIA's not even on the traditional calendar year. Their fiscal year is shifted by a quarter, so it doesn't even make sense to trim them on a calendar. They don't even fit your calendar if you were going to rebalance like that. So there are a lot of ways that the traditional rebalancing approach doesn't make sense, and we favor the macro based, the trend based, and the portfolio maintenance. Yeah, we'll trim it if it becomes outsized in the meantime. But until those macro forces really change, there's no reason to sell NVIDIA and start buying utilities or any other, industry that like last year was so out of favor relative to the rest of the market.
Exactly. And trends tend to last for long periods of time. Many trends will last anywhere from a year to 3 or 4 years. I certainly don't see the AI trend ending just because it's 2 years old now. It's going to go on for quite a while. And other sectors that are out of favor stay out of favor for long periods of time too. Sometimes it's just the Fed raising interest rates, or the interest rates are higher, or they're reducing interest rates. It's many different factors, but the trend keeps going. So why would you want to sell things that are in favor and turn around and buy things that are out of favor? I think rebalancing is one of the silliest notions ever. And then on top of it, the taxation. If you're constantly selling every quarter you're selling, or every half a year, or whatever your period is, if you're selling your winners to buy losers, that means you're selling winners, you're paying short-term capital gains taxes constantly. So from a tax standpoint, it makes no sense. From an investment standpoint, it makes no sense. I really don't understand how rebalancing became a theme in this industry.
Yeah, and I think that's a big differentiator as well, is not only the long-term investor mindset, the long-term capital gains treatment, but also the ability to strategically tax loss harvest things along with it, because in your calendar rebalancing, you'll never have that. You're always buying the things that are underwater and selling the ones that you've made money on. So being able to strategically trim positions that may have gone down a little bit, take those tax losses and offset some long-term capital gains.
Well, that's a real good point too, and that's another thing that rebalancing pretty much is predetermined by, is that you almost have to be using mutual funds or ETFs. So in any mutual fund or ETF, or if you're buying the index funds, you're basically buying all the good companies and the bad. You buy the S&P 500 index fund, and you now own the worst 100 companies in the S&P 500. In fact, you own 250 companies that are in the bottom half. I would suggest why not look at the most profitable half and start picking from there. The second thing that does is it allows you to hone in on what you believe are the best companies positioned for this type of market environment, and the most profitable, and the ones that have a growing future. So from a logical standpoint, it seems to me that makes better logic than just owning everything. I'll own the good and the bad because I don't really know what in the world's going on.
Yeah, and I think a great way to think about that too is it's not only about picking the winners and trying to seek enhanced returns due to picking winners, but also risk management on avoiding those sectors and companies within those sectors that are just out of favor or just fundamentally not there, right? So it's not only trying to pursue upside, but it's also at the same time trying to limit that downside too.
That's true. And you hit on a good point a minute ago about the taxation. Not only is the rebalancing a problem for taxation, but let's just forget that and talk about just regular investing. Sometimes things happen by surprise, and you pick a good company, and they're probably a good company for a long period of time, but something happens short term, and there's a loss in the position. Well, if you have individual securities instead of mutual funds and ETFs, you can actually go ahead and realize that loss, sell that if it looks like it might persist for a month or a couple of months or what have you, because you can always come back and buy it a month later. Very often we'll use, if we find a company that we are certain is a good company, but something happens short term. It may not even have to do with that company. It might have to do with policy. The government comes out and says, we're not going to sell our best chips to the Middle East or to China or to whatever, just like they have recently. Well, you might get a just unlucky timing or something. Well, very often you can take that company, you could sell the company for a loss and take the tax loss, so let the IRS pay 30 or 40% of the loss. You can buy it back in 1 month or 31 days and you get to maintain the tax loss. Or sometimes we'll, for a short period of time, find an ETF that maybe has 20%, 25% of that particular stock in it. When you have that, well, then you can sell that stock. You can buy the ETF. Sometimes there's two stocks that, or companies. I like to call them companies rather than stocks because these aren't just pieces of paper. You actually have ownership in good companies. But sometimes there are two companies that are in very similar business, and maybe they even kind of compete with each other or a little or a lot. And if you look at their stock charts, you see that they kind of mirror each other a lot. Well, you can always sell the one you had, even if you liked it a little better. And for 31 days, if you want to stay exposed to that sector or subsector, you can buy the other one. Then consider switching back in 31 days if it makes sense.
Yeah, no, exactly. That's a great point with that. So I want to take us back. We talked about our macro approach, 30,000 foot view of the world, trimming that down, narrowing it down, sectors we like, sectors we don't like. And then one more layer beneath that we didn't really talk about, because that's where you have your indexing, your broad rebalancing stuff going on. One more step below that we really pride ourselves on is once we identify the industry or the sector, is finding the companies within that are really poised to do the best out of them. Because if you have, 5 sectors that are in the top half, then you still have companies within those sectors that are in the bottom half. Rising tides raise all boats, but some boats raise higher and faster. So you want to talk to us a little bit about, kind of what we look for in these companies when we're trying to identify the best ones.
Well, of course, it gets down to what they're actually doing within that industry. But, some of the things we're looking for too is I would call us GARP investors. We like growth at a reasonable price. But a reasonable price is not a PE. People, you see on television all the time, commentators, the talking heads, they're saying, oh, the stock market is expensive compared to what it has been historically. And they're talking the PE, the price to earnings ratio, is at 21 right now. And it's historically been at 19 or 18 or whatever the number is. It's pretty meaningless what it was historically, because if you look historically, 20 years ago or at the turn of the century, technology was about 10% of the S&P 500 and banking was about 25%. Well, today it's exactly the opposite. Banking's probably less than 10%. Technology is almost 30%. Technology companies tend to grow a lot faster. It goes back to the point where if you were looking at 2 7-Elevens, or just call it convenience stores, and one of them was in a new, vibrant, fast-growing part of town, and the other one was in an old part of town that's not growing and is kind of more of a dying part of town. And you could buy the one over there for 10 times its current earnings, and the one in the vibrant part of town costs you 20 times its current earnings. But the new one is growing its earnings every year at 20, 25% per year, and the old one's growing theirs at about the inflation rate. Well, would you rather pay just 10 times earnings, or would you rather pay 20 times earnings and have that 25% growth. And that's the difference between technology and banking. Banking and utilities tend to grow very slowly. Their earnings growth is slow, and technology is very high. So, of course, when you have a market that is now 30% technology, you would expect to have a little bit higher PE. So when you hear people talk about just PE and not add in the dynamic of growth, so price to earnings to growth or PEG ratio, to us, that's a much more significant measure to look at.
Especially in the modern day and age where we're going through another technological revolution right now. It's the whole AI race, and AI just in general is growing the earnings of these tech companies so fast, and of some right now, some in the future, but the whole space is undergoing so much progress and change in such a short amount of time that's exceptional. It's not the normal, what it's been for the last 10, 20, 30 years of rate of change. Maybe we have to go back that 24, 25 years to really see the same kind of growth in that technology space.
Yeah, that's true. And even what you hit on is, reminds me of one more thing, is that when we're looking at countries, and then we're looking at sectors within those countries and subsectors, well, you get down to something like technology, and you say, well, yeah, technology's a wonderful place to be pretty much across the board. But then you dig a little further and you see that, well, right now, AI, the people that are really making the money today on AI are the picks and shovels of AI, the semiconductors. They're making the stuff. You have companies that are making the chips and the graphics processing units, making the just different types of semiconductors. And then you have people that are actually taking those and putting them into a box, so you have an AI box on demand or a computer on demand for your servers. Well, those people are making a lot of money right now, whereas the next phase of it will probably be the software companies. Right now, the software companies are tending to, you have the Metas and even the Microsofts and the Amazons and such. Not that they're not making money. They make money in a lot of ways. They're mega cap companies, and they're into a lot of things, but they are spending a lot of money on the picks and shovels right now, on the semiconductors, and building up their AI. At some point, they'll start making a lot of money from having written those checks. But we always say, hey, we very much like to buy companies after they've been signing the front of the check and they start signing the back of the check.
Exactly. And something that we've seen over the last really quarter is all of this money that's flowing into the AI space. A lot of that's new money in R&D budgets, but at the same time, a lot of that is getting shifted from some of these more traditional software as a service companies. And so that's kind of what we're looking for as far as the flow of capital even within a sector, is that, some of your really good companies are temporarily out of favor because everyone's diverting their attention and their funds to building out their AI capabilities.
Well, I think that pretty much says it, but and that's our philosophy. And
well, thank you, Frank, for joining us on the Beconomics podcast. Reminder to all of our listeners to like and follow for more. We are everywhere you can find your podcasts, as well as Facebook, Instagram, and online at betcapitalmanagement.com. Thanks.
Thank you.